Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Fed Chairman Jerome Powell and Treasury Secretary Janet Yellen testify before Congress. So, arguably, the two most important and certainly the most powerful people in the economic universe, that is, Fed Chairman Jerome Powell and Treasury Secretary Janet Yellen, came before Congress this week to talk about their outlook for monetary and fiscal policy. What does all that mean? Well, effectively, Congress wants to know how all this money we're spending is going to affect the economy, and more importantly, how we're going to pay for it. Yellen and Powell basically said that we've made good strides in terms of our recovery from the pandemic, but we still have a long way to go, and they're willing to do whatever it takes to make sure we do. Recover, that is. So as far as inflation, a lot of people are concerned about those rising price pressures. Both Yellen and Powell think that it's manageable, but if we do get into a situation where inflationary pressures get too hot, we can always just raise taxes. So if we're going to raise taxes, it's important to work through what the economic implications of that would be. From my elementary economics class, we learned that aggregate demand here and aggregate supply meet at a certain level of GDP and at a certain price level. If you raise taxes, you reduce the level of aggregate supply, you wind up with a higher price level, and you wind up with a lower level of GDP. So raising taxes to reduce inflation would actually have the opposite effect. You'd end up with a higher price level and a lower level of aggregate demand, otherwise known as a recession. For this week's featured insight, there's no free lunch. So one of the biggest pitfalls we see investors make is they try to select investments with the highest yield. Why buy a stock that only has a dividend yield of 3% when you can find one that pays 4%? Why buy a bond that pays 2% interest when there's one out there that pays 3%? It's important to remember that there's no free lunch. Higher yield typically equals higher risk. It does you no good if the stock you own that pays a 5% dividend goes down 10% in value. So remember this when you're out there searching for yield. There's no free lunch. Looking ahead, quarter-end rebalancing. So with the first quarter of 2021 coming to a close next week, institutional investors like mutual funds, pension funds, and 401k plan providers will be doing their quarter-end rebalancing. That is, rebalancing asset allocations back to predetermined targets. With stocks having performed so well over the course of the last year, and now interest rates having risen recently, a lot of that rebalancing will be pulling money out of stocks, that is, putting selling pressure on the market, and flowing into bonds. This could create some elevated volatility over the course of the next week or two in markets, and that's very important to remember, especially if you're putting new money to work. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Thanks for watching the video. Be sure to like, subscribe, and hit that little bell for notifications. And also make sure to connect with us on Twitter, Facebook, and LinkedIn. For all of your business news, visit businessjournaldaily.com. For all of your arts and entertainment news, go to afterhoursyoungstown.com.